let's talk about something more interesting, like stagflation fears intensify in signs of slowing growth. Gas prices up. Oh my gosh, 135 of some currency for regular unleaded. All right, let's see what we got. Supply chain disruptions sweeping major economies have reawakened an old nemesis for investors, stagflation. Anxiety over rising inflation has been ever present in markets this year, but with oil topping $80 a barrel, global food prices a third more expensive than they were a year ago, and other commodities at decade highs. Investors say a longer than expected inflationary surge is coinciding with a slowdown in growth and making it worse. Hey, this is interesting. I mean, they're all right. The UN just put out the report about food prices going up 33% year over year. That is a tax on poorer individuals or households that aren't millionaires, certainly, right? It's just crazy. Okay, so economists and investors play down comparisons with the aftermath of the 1970s oil shock. A lot of comparisons to the 1970s. Even Cathie Wood has compared to the 70s and said things like, "This ain't the 70s. This time's different." Investors say longer than expected inflationary surge is coinciding with a slowdown in growth. Then, in the 1970s, inflation and interest rates ran into the double digits, unemployment soared, and the GDP recovered only slowly from repeated setbacks. But with energy bills now rocketing, many worry about a growth slowdown at a time when central banks are edging towards lifting rates in a bid to keep a lid on longer-term inflation. Conversation around inflation has definitely shifted. Well, yeah, no kidding. Okay, so you got energy prices going up, you got food prices going up, you've got the economy slowing down because the stimulant is starting to wear off. We'll see what kind of side effects we have of all that money printing. Signals from the Fed and Bank of England last week were that they could soon begin lifting rates. Let's see, fueled a big bond sell-off, which increases yields, of course. But in contrast to the reflation trade at the start of the year, stocks have been unable to draw comfort from the prospect of tighter monetary policy. That's true. Recovery stocks started selling off, which were often deemed the deflation or reflation trades, and tech has been selling off a bit. Everything's just selling off a little bit. All right. Ample evidence suggests that a supply shock reverberating around the world, combined with other outbreaks of Delta, is tempering growth. I'm not so. How concerned is everybody about Delta? I think widening. There was actually a headline. I don't know if I have it here, but there was a headline in the Financial Times about how basically Europe. Yeah. Here, it's right here. Okay, Eurozone consumer activity returns to pre-pandemic levels, and I thought this was a really interesting piece. I wasn't really going to talk about it because I just read this stuff all the time, and I don't talk about everything that's in this stuff. But it's literally the front page news right here. This is today's paper. It says, Europeans are shopping, eating out, and traveling and visiting cinemas as much as they did before the pandemic in a sign of returning consumer confidence across the Eurozone. Data on economic activity in September suggests that consumers feel emboldened by high vaccination rates despite worrying economic news, including higher energy bills, supply chain disruptions, and fears of a slowdown in China. For now, data remain consistent with a decent pace of recovery. Some of the rebound is because schools are reopening, but an increase in leisure activities also suggests consumers are now more confident. Cinema revenues have already returned to pre-pandemic levels. I am shocked by that because when I go to the movie theater, there aren't that many people there. Let's see here. OECD Weekly Tracker of Economic Activity, which uses real-time high-frequency data indicators, rose above 2019 levels at the beginning of September. That's good. That's bullish in Eurozone. Positive momentum might give the ECB confidence it could scale back emergency stimulus. Yeah, we've already talked about that, back from the brink. But not out of the woods because of supply bottlenecks. So I think the consumers are there. Consumers are interested. Yeah, so, okay, let's go back to the FT over here. Okay, data released pointed to a sharp slowdown in Chinese manufacturing. Regulatory pressures. A lot of the negativity has a reason, and that's a good thing. It makes me feel more comfortable. It's okay, people are complaining about Congress or complaining about China's regulation and Evergrande, which is really a symptom of the Chinese Communist Party changing their regulatory stance towards debt. So far a lot of these things are very explainable, and it makes it really hard to consider that, oh no, stocks are somehow, destined for a big mega collapse or whatever. I mean, hey, like, you never know. I mean, nobody saw the pandemic coming, except when it started happening and people got rich off puts when it started happening, which makes sense. I mean, that's one of the first things people do when the market's crashing. I was just spending my money buying the dip. But anyway, selling activity spilled over into equity markets this week after data showed that U.S. consumer confidence had dropped to a 6-month low. The UK found itself at a sharp end of stagflationary concerns with a surge in energy prices. Okay, so it's interesting how confidence, I personally wonder how much consumer confidence in the US is based on what the stock market is doing. Because even though we've seen some economic slowing, there are a lot of indicators, especially Europe, which seems to be a little bit ahead of us in terms of COVID, that people are spending again. So it's always weird to try to tie this all together. Because on one hand, we've got more cash than we've ever had before. On the other hand, I believe we're going to be in a little bit more of a frugal decade, because I don't think people are going to spend themselves into oblivion like they used to. The European Union, while we're having some setbacks with energy prices, is actually doing very well in regards to consumer activity. But then you have consumer confidence measures in the U.S. a little low, maybe because of Delta and all this other congressional nonsense. But I expect that to U-turn. So we'll see. With revised data, show activity, while revised data show activity bounced back faster than thought over the summer, the recovery appears to be faulting, at least in the Bank of England. So you get these mixed signals. Both of these are from the Financial Times today. On one hand, they're saying Europe's doing better. Now here they're saying the recovery appears to be faltering, according to the Bank of England, but it's because of supply bottlenecks. So these are two different things, right? So it's like, okay, yeah, supply bottlenecks are getting worse, but people want to spend money. This is more important, in my opinion, than supply bottlenecks. Now, supply bottlenecks are going to have a more immediate term impact on stock prices. Like, supply bottlenecks are going to suck. They're going to hurt stock prices. They're going to hurt GDP growth. But consumers apparently have the willingness to spend. And this is good. Recovery takes hold. Leisure rebound suggests confidence. But, of course, you have threats. Energy prices, supply chain shortages, price increases. So it's like people want to go back to normal. But, yeah, there are some headwinds. This makes sense. Makes a lot of sense. I mean, people want to buy a Tesla, and they don't want to have to wait until March for one, but they will, because they want a Tesla. Concerns over growth are one reason the pound has not benefited from the sharp rise. If it's stagflation, central banks are in a bind. Hiking interest rates will reduce demand, which will slow growth, but if you're already slowing growth through stagflation, then that's bad. That's if you believe in the deflation or stagflation narrative. That's probably the biggest argument for a market crash right now is stagflation. That's it. The economy's going to slow down its growth, and at the same time, we're going to raise rates and we're going to be screwed. But the only reason, in my opinion, the economy's growing slower is because there's this giant anchor behind us, and it's an anchor of many different things. The rent crisis, the high amount of unemployment, as people transition to different jobs, supply chain shortages, shorter term inflation, right? All of those things are like this giant anchor. And consumers are like, we must move on and keep going. It'd be nice to cut that anchor. So inflation should start to ease in 2022, and the situation was still a long way off anything like the 1970s. We won't see inflation get into the system like we did then, says Vicky Redwood, a senior economist or economic advisor at Capital Economics. Others warn, however, that there is no signs yet of strains on supply chains easing, and that the world could be heading for a more sustained period of tepid growth and high inflation. So that's really it. It's basically what we're saying here. If supply chain problems continue for a further 6 to 12 months, while consumers still had job security and were willing to pay for goods they wanted, he said, the whiff of stagflation might be more of a stench. Wow, that was a complicated way to word that. Okay, got it. So basically, look, consumers are happy. They want to get back to normal. They want to go back to traveling. They want to go to restaurants. They want to spend money. They've got more money than ever. But again, we've got this giant anchor that we're dragging around called inflation because some prices are going up. Supply chain shortages making us wait longer. We either have to pay with our time or we have to pay more money. Remember, you pay more money for things like shipping costs to get the stuff on time, or you pay with your personal time because flights are getting delayed or hotels are booked up or whatever, right? But overall, I don't know. I'm not a big proponent of this whole stagflation thesis. But then again, I've been very consistent on this channel that I believe inflation is going to inflect down, whether that's next month as a start or in 4 months from now as a start. We are going to inflect downwards on inflation. But sure, supply chain issues are a crisis, and at some point they'll be up and running again. I just want to ask you this, and this is a great way to leave off. How do you think, with how much more productive our markets have gotten, our economies and our businesses have gotten, the cheap credit our businesses and our markets have gotten, how do you think our economy would be doing right now if we had zero supply chain shortages? And literally ask yourself that. How would the economy be doing right now with the amount of money people have, the appetite people have to spend, and no supply chain shortages? Would we be at all-time highs on the stock market? Would GDP be at the highest place ever? And so now, picture that moment where businesses are more productive, people have more money, and people have more willingness to spend. Just not now. Picture it at like the end of 2022 or 2023. And that's what I'm investing for. I'm looking at 2021 as like, I'm planting seeds, man. I'm planting seeds. I'm going around going, yep, buy that, buy that, buy that, buy that. So I think it's hilarious when people, like, after a week of me saying, I'm going to buy I'm going to do a fundamental play. It's like, how come it hasn't gone up 30% yet? It's like, well, there are different ways to invest. It's not all Camber Electric, which I had tried to short sell this morning or buy a put on, but I couldn't. I'm sorry. I might do a video on them, like a standalone video. But anyway, think about it. All right, folks. Appreciate you being here. We will see you in the next one. Just make sure to go to metkevin.com/public to get yourself a free stock worth all the way up to $70. metkevin.com/public, and we'll see you in the next one. Thanks again. Goodbye.